I'm about to settle the biggest debate in investing. Do you go for insane, high-yield cash, or do you chase stocks that could explode in value? It's the ultimate question. Do you want money in your bank account today, or a portfolio so big it breaks the internet? But what if I told you that entire debate is a complete lie? Seriously, what if you could have both? Looking at 2026, the biggest mistake you can possibly make isn't picking the wrong stock. It's thinking you have to choose. The game has completely changed, and the tools we have are crazier than ever before. In this video, I am literally giving you 5 secret ETFs that could hit both goals: insane monthly cash and real growth. And no, these are not your grandpa's boring, sleepy funds. We are going to explore some next-level strategies, including funds that use daily options to print money while still riding the market's insane upward momentum. By the end of this video, you will have a list of funds to build a portfolio that's a literal income and growth machine for 2026. After years of using these strategies for my richest clients, my new mission is to bring these exact same secrets to you. So, let's get into the challenge. The secret hack behind these insane yields is a strategy called covered calls. Here's the 10-second version. Imagine you own a stock. You're literally renting it out by selling someone the chance to buy it at a fixed price. For selling them that ticket, they pay you a fee right now in cash. That's your income. If the stock price does nothing, goes down, or even goes up a little, you just keep the cash. It's free money. The catch? If the stock suddenly rockets past your price, the other person takes your shares, you still get paid, but you miss out on the god-tier gains. You swap unlimited upside for huge monthly income. These ETFs are incredible in shaky or flat markets, but they will get left behind in a crazy bull run. But here is the 2026 game changer. New ETFs have put this on hyperdrive. Instead of using options that expire every month, they use options that expire every single day. This lets them reset their price daily, giving them a way better chance at capturing all the upside when the market goes parabolic. It's a genius way to balance income and growth. With that, let's get to the list. These are the 5 monthly paying ETFs I would pick for a high-yield, high-growth portfolio in 2026. Section 1. The Small Cap Income Machine, RDTE. First up is an absolute monster, the Roundhill Small Cap Covered Call Strategy ETF, ticker RDTE. I'm calling this one the Small Cap Income Machine, and you're about to see why. This ETF is insane because it plays with small cap stocks. Normally, you buy these tiny companies for explosive growth, not cash. RDTE flips that upside down. It uses a synthetic covered call strategy, which is a fancy way of saying it uses crazy option strategies to copy the index while selling daily call options against it. The result is a yield so big it looks like a typo, but who cares about the yield? What we want is the total return. This strategy turns the wild volatility of small companies into a literal fire hose of income. And because it uses daily options, it can actually capture more of the gains when the market rallies. So, why for 2026? Small companies have been getting destroyed by big tech for years. If the market finally flips and these little guys have their moment, RDTE is built to give you insane income and the growth from that rally. Now listen, this is an aggressive play. Its structure and the fact that it's tied to volatile small caps means you have to be willing to take a risk. The expense ratio is 0.97% because this is a complex machine. This is for someone who wants to bolt a supercharger onto their portfolio and is ready for a wild ride. Section 2. The Tech Growth Supercharger, TSPY. All right, ETF number 2 is making absolutely massive waves, the Tap Alpha SPY Growth and Daily Income ETF, ticker TSPY. We're calling this the Tech Growth Supercharger. This fund gives you something we all want. The entire S&P 500, but with a giant income engine strapped to it. Just like RDTE, it uses a daily covered call strategy to generate a crazy dividend yield. We're talking over 13%, while letting you ride the S&P 500's growth. The fund literally just holds the S&P 500 and sells daily options to print cash. Its performance since it launched in August 2024 has been unbelievable, posting double-digit returns. If 2026 brings lower interest rates and tech keeps going to the moon, the S&P 500 will hit new highs, and TSPY is designed to ride that wave. Its daily reset gives it a massive advantage over older funds, but That daily reset also brings more risk if the market gets weird or goes down. Its expense ratio is 0.77%, which is what you pay for someone actively managing this every single day. And here's a secret you have to understand. Some of that huge payout is return of capital. Don't freak out. It's not bad. The fund is literally handing you back your own money, tax deferred. Just don't think it's all pure profit. TSPY is for someone who thinks the US market is going to keep winning and wants to squeeze every last drop of monthly income out of it. Wait! If your mind is being blown right now thinking about how you can get both growth and income, do me a favor and destroy that like and subscribe button. I go deep on insane strategies like this every single week to help you build a bigger portfolio, and I want you to be a part of this community. Section 3, the Bedrock Stabilizer. Inside. ISP. Okay, so the first two picks were absolutely wild. Now we need a beast for our foundation. This is our third pick, the ProShares S&P 500 High Income ETF, ticker ISP. I call it the Bedrock Stabilizer. Like TSPY, this ETF is all about the S&P 500 and uses a daily covered call strategy for insane income. Its entire mission is to track the S&P 500 Daily Covered Call Index. What I love about ISP is the balance. Since it launched in late 2023, it has delivered an insane total return, crushing many of its older competitors while still paying out a huge distribution rate around 9%. That makes it almost impossible to ignore for anyone who needs monthly paychecks. ProShares basically invented this daily options strategy, and ISP is their champion for the S&P 500. A huge difference is that ISP physically holds the stocks, which makes it feel way more stable. The expense ratio is also super competitive for this kind of strategy. For 2026, ISP is the core of your portfolio if you want massive monthly income from the S&P 500, but with a modern strategy that is proven to capture more growth. This is a game changer for retirees, or literally anyone who wants cash flow without giving up on growth. Section 4, the All-Weather Opportunist. Devo, all right. Our fourth pick is a completely different animal. This is the Amplify CWP Enhanced Dividend Income ETF, Devo, and I call it the All-Weather Opportunist. While the other ETFs are basically robots, Devo is run by actual humans. The managers literally handpick a small portfolio of 25 of the best blue-chip companies in the world. Then, and this is the secret, instead of running a covered call strategy 24/7, the managers tactically sell calls only when they think the time is perfect. This genius, selective approach means Devo is designed to give up way less of the upside compared to funds that are always capped. It generates cash from two places: the dividends from its amazing stocks and the extra money from writing options at the perfect time. The fund targets a total income of 5-8% a year, which is an insane mix of dividends and options income. Devo might not have the biggest yield number, but its focus on total return and managing risk is what makes it a legend. It has an incredible track record. With an expense ratio of 0.56%, it's a bargain for having a real person making smart moves for you. Devo is for the investor who wants a pro in their corner, giving them a smoother ride and a fat monthly check. Section 5, the Canadian Dividend Fortress. ZWB for our last pick. We are literally leaving the country and going to Canada for the BMO Covered Call Canadian Banks ETF, ticker ZWB. This is the Canadian Dividend Fortress. So, why Canada? The Canadian banking system is famous for being an untouchable fortress of stability that pays dividends that never stop growing. It's an oligopoly. Only a handful of giant banks control everything. This creates profits so predictable it's almost boring, with way less drama than US banks. ZWB buys a portfolio of these top Canadian banks and then writes covered calls on them to pump up the income, which it pays out every month. This gives you a massive yield built on some of the safest financial companies on planet Earth. BMO is a giant in the covered call world, and this is one of its most popular funds ever. Even though it's Canadian, US investors can buy it easily. Just look for ZWBU. The expense ratio is a competitive 0.73%. Adding ZWB gives you amazing diversification away from a portfolio that's probably all US tech. In 2026, when interest rates might finally chill out, banks could do incredibly well, and ZWB lets you collect a huge paycheck while you wait. This is for the smart investor looking to diversify their income and build their portfolio on solid rock. So, let's recap the team we just built. You have RDTE, the small cap income machine, for aggressive income and moonshot potential. You have TSPY, the tech growth supercharger, for pairing the S&P 500 with a monster yield. Then there's ISPY, the bedrock stabilizer, as your core income play. You've got Devo, the all-weather opportunist, for genius, active management. And finally, ZWB, the Canadian dividend fortress, for untouchable stability and diversification. The biggest takeaway here is that you don't have to choose between income and growth anymore. By using insane ETFs like these, you can build a portfolio that does both. It hands you monthly cash while your money keeps growing. I will read every single comment. Which one of these 5 caught your eye the most? Drop it in the comments below and let me know. And if you want to see exactly how I would mix these into portfolios for different risk levels, you have to subscribe, because that video is coming next. Thanks for watching this challenge, and I'll see you in the next one.